In this video, I'm going to discuss the Fed and the challenges it faces. Janet Yellen has now taken over as the new Fed chair, so let me begin with a few words about her. She has a great deal of experience. Before this, she was vice chair of the Fed. She also served as the president of the San Francisco Fed, and she was chair of the President's Council of Economic Advisors. She has good judgment. Among the people on the FOMC, she was the first to see the crisis coming, and she also saw better how the crisis was likely to play out. Unlike her predecessors, Alan Greenspan and Ben Bernanke, Janet Yellen is not responsible for this crisis. She's more concerned about the high rates of joblessness now than about the risk of high rates of inflation in the future. So she's considered dovish. This suggests there'll be more monetary stimulus for longer. The March 19th FOMC meeting was the first under her chairmanship. Her comments then at a press conference after the meeting raised questions about when the Fed will increase the federal funds rate. You can see here the federal funds rate, the Fed's policy rate, has been 0% now since 2008. At that press conference, a journalist asked Mrs. Yellen indirectly when the Fed is likely to increase the federal funds rate. And in response, Mrs. Yellen replied, most probably something like 6 months after QE ends. But she stressed that this depends on incoming data. This was about 6 months earlier than analysts had expected. So the markets took fright, and there was a considerable stock market sell-off that day. But in my opinion, the idea that the Fed will increase the federal funds rate next year is based on an unrealistic set of assumptions. If quantitative easing ends, then the United States will begin to go back into recession, just as it did after the end of QE1 and again after the end of QE2. At that point, the Fed will be forced to launch another round of quantitative easing, QE4, and it will also be forced to leave the federal funds rate at 0. So here's the Fed's taper schedule. As of April, the Fed will create $55 billion. Now they've told us that they intend to reduce the amount of fiat money they create every month by $10 billion after every FOMC meeting. So here's the schedule. And after creating $205 billion in the first quarter, that means they'll create another $145 billion in the second quarter, $85 billion in the third, and $20 billion in the fourth. So in the short term, the Fed's challenge is going to be preventing very high rates of excess liquidity during the second quarter from creating a stock market boom and bubble between now and mid-year. Here you can see my liquidity gauge. And in the second quarter, there's going to be a great deal of excess liquidity. That's because the Fed will create another $145 billion of liquidity and inject it into the financial markets. But the government will not be absorbing any liquidity from the financial markets because during the second quarter, the government is likely to have a balanced budget or even a budget surplus. And that's because Americans pay taxes in the second quarter. So we're going to have a very great deal of excess liquidity during the second quarter, and that could create a stock market boom and bubble. So the Fed's challenge is going to be to try to prevent that from happening. So what we can expect is probably to see a lot of members of the FOMC trying to talk down the stock market over the next 3 months. But in the medium term, the challenge is just the opposite, because liquidity begins to dry up in the third quarter, and it turns significantly negative in the fourth quarter. Here you can see there'll be less quantitative easing and more government borrowing, so liquidity dries up. And that means that interest rates on government bonds and mortgages are likely to begin to rise, and that property prices and the stock market, and therefore net worth and consumption, are likely to begin to fall. At that point, I believe the Fed will be forced to extend quantitative easing to prevent the US from falling back into recession. Now, the Fed's long-term challenge concerns the ratio of net worth to disposable personal income, which you can see here. On average, since 1952, it has averaged 525%. But during the NASDAQ bubble, it went up to 615%. And then that bubble crashed, and this ratio corrected. And then during the property bubble, this went to 660%, an all-time high. And that bubble crashed, and this ratio corrected. Now it's gone back up to 639% as a result of the Fed, its quantitative easing program, and the effect that's had on pushing up asset prices. Household sector net worth now is $81 trillion, an all-time high. So this is flashing a warning signal that asset prices may once again be approaching a new crash. So there's a limit as to how high this ratio of wealth to income can go. And that's because when asset prices become very inflated, much more inflated than income, the public simply doesn't have enough income to service the interest on the inflated asset prices, and then the asset prices crash. So this means that there is a limit as to how long the Fed can drive the economy by creating fiat money and pushing up asset prices. And it looks like we're approaching that limit. So in conclusion, I don't believe the Fed will increase the federal funds rate in 2015. And I don't believe quantitative easing will end this year, as the Fed is now indicating. Also, I'm growing increasingly worried that the Fed may be nearing the limit of its ability to drive economic growth through fiat money creation. If that turns out to be true, and if Congress refuses to provide fiscal stimulus, then this crisis will resume, and the world will once again face the risk of collapsing into a new depression. Okay, I believe the Fed should be able to continue driving economic growth through the end of 2015 at least. So my views on the prospects for asset prices haven't changed. Rather than repeating those views again here, let me ask you to go back and look at the last issue of Macro Watch and see the video, Liquidity Conditions in 2014 and Prospects for Asset Prices.